we look back at what you did while you were there at the central bank. Let's talk about where you finished off in January last year when you retired in terms of financial sector surveillance. What does it really mean?
Well, financial sector surveillance, that was the activity I undertook in the first 6 years of my stay in central bank. I was in charge of operations in the last 4 years. But let me answer your question. Financial sector surveillance, I was basically a regulator. In other words, a regulator of the banking industry and other non-bank financial institutions, microfinance banks, primary mortgage institutions, bureau de change, and so on and so forth, including discount houses.
That's quite a lot.
Of course, it is.
Okay, so what does it mean looking at the system on a daily basis for you? Do you ever sleep?
Well, you just have to sleep with one eye open. Particularly in January 2004, when I joined Central Bank, there were 89 deposit money banks. And many of them had very, very little capital. Many of them were technically insolvent, and yet they were still managing to operate. And only very few of them were big. So indeed, it was a Herculean task then, because you had to ensure that on a day-to-day basis, you don't have any panic from customers. You don't have anyone that will suddenly close shop and not pay depositors. While you are keeping eye on that, you are also trying to ensure that they lend to the critical sectors of the economy. So it was like juggling 4, 5, 6 balls with 2 hands.
So in a manner of speaking, you were the National Security Advisor to the Central Bank Governor at that point in time.
So to speak.
So to speak. You were the NSA of the Central Bank. Okay, now, one of the key things that came into effect while you were at the Central Bank was the EFAS. Making sure the whole system for the old banks is on a single page, and at a single punch of the button, you can see what all the banks are doing. Now, talk to us about that system and what has it helped to bring about in Nigeria's banking sector over the last couple of years?
Yeah, EFAS has assisted us a great deal. Prior to the implementation of EFAS, many banks were into unethical practices then. I mean, we used to joke about it in Central Bank that some of them kept 3 sets of books, one for the shareholders, one for the tax officer, and then one for the regulator. But with EFAS, it was difficult for them to do that because as the transactions were kicking in, as the transactions were happening in their banks, it went straight into our portal, and it is reported. And so that has assisted us to deal with falsification and figure doctoring and so on and so forth. And then, of course, it's also helped us to actually nip issues in the bud before it gets too late. A stitch in time, they say, saves 9. With EFAS, if there is a problem, you can know upfront, and then you can deal with it before it contaminates the other system, because contagion is a very, very serious issue in banking. You don't allow an issue building up in a particular financial institution that could contaminate the rest of the group if it is not dealt with immediately. So EFAS has been very, very helpful to Central Bank. It has helped regulation. It's helped also to monitor, to say offsite supervision, so to speak. I mean, the Central Bank has been a lot more effective in supervising the commercial banks through EFAS.
Are you satisfied with where we are in regards to financial sector surveillance? Are you?
Well, you can never be satisfied. You can never be satisfied. I recall even the Western countries, when they thought their financial institutions were very strong and steady, then they began to embark on what I call light touch regulation. And then, of course, we had the financial crisis in 2008-09. So you really cannot be satisfied because every new day, the economy is dynamic, and then, of course, there are new tricks and new things. So you must be one step ahead of the operators. They have been building up, they've been ramping up. There have been areas of concern. We've dealt with risk management. Concentration could still be an issue, not because of the fault of banks, but because of the structure of the economy. And so there are new regulations day by day to strengthen the existing regulation. And then, of course, technology has also helped a great deal in ensuring that those leakages are blocked, and then the system is also made as ubiquitous as possible.
There were a number of other developments while you were at the central bank. You stepped into the central bank just around the bank consolidation program. Then we had the market meltdown, the stock market, the great meltdown, or the Great Depression. Then we had the setting up of AMCON, the bailouts of the banks, some of those banks, the 2009 name and shame. You were there at the central bank. So are you satisfied with the way things have been handled in the last 10 years, to be more precise, from the bank consolidation 2005 mainstream to 2015?
Things have improved a great deal. 2004, 2005, we saw very small and marginal banks that could not impact in the risk sector. And then with capital raising exercise, that was dealt with in 2005, 2006. And then, of course, because of the benefit of robust capital, they then began to embark on self-imposed higher capital, which, of course, unfortunately, because of some rascality, also led to the problem in 2008, 2009, no thanks to the global financial meltdown and the issues around the capital market, which, of course, led to yet another round of reform that we put in place in 2009, which, of course, made us to then say universal banking carries with it a lot of risk, and then we began to then take off non-banking activity from commercial banking activity. We embarked on narrow banking policy, and then banks that want to do activities that are non-core should then restructure as a group instead of having everything warehoused within the bank. So all of that now meant that we had Chinese wall around depositors fund, protection of depositors fund, no longer available for proprietary activities in the capital market. And so there has been significant development in the last 10 years. What do we have now? We now have very, very strong banks that are well capitalized, that are internationally active, and they are no longer bystanders whenever big deals are discussed in Nigeria. In those days, if there was a big ticket transaction in the upstream energy sector, Nigerian banks were spectators. But today, 2, 3, 4 of them will sit down on a club deal and sign deals, and then billions are rolled out.
Having club sandwich.
Of course, of course. So because of that, we've got them to be a lot more active. There are challenges, but in the last 10 years, there have been significant growth in the size and level of professionalism in the banking industry.
Well, looking back as a business journalist in those days, attending the central bank intervention meetings, I remember 2009, you were there, the central bank in Marina, Lagos, when the then central bank governor announced the intervention in the first set of 5 banks, Oceanic, Intercontinental, and the rest of them, Bank PHB and Co. And I remember your face very well back then, looking seriously worried. Now, the burdens of a regulator. Let me just announce it, Central Bank Governor Dan Emir of Kano looks really also looks stressed, as it were, looking back at the atmosphere. You kept us waiting. You folks actually kept us waiting for about 2 hours, and we were speculating what you were going to announce. That was a few months after he came into office, about 3 months or thereabout. Was actually
14th of July.
14th of July, to be precise. So, talk to us about the burden of a regulator. You have banks collapsing on one hand, then you move on very quickly. You're trying to prevent chronic bank debtors issue. You have to make sure that everything is fine. Depositors don't walk out on with their cash in their pockets.
Well, the event of 14th of, not July, August, 14th of August, is a watershed in the history of Nigeria. We took a risk then because not doing so could have been the easy way out, but then we will have had zombie banks, banks that were structurally weak and yet permitted to continue to trade. But then there was also the downside risk of going the way we did and then having very serious banking crisis that could snowball into economic crisis and then become something we couldn't handle. And so it was a risk that we took, but thank God it's worked out. Today, you can now see the positive effect of what we did. Now we have banking industry that is much bigger. And then, of course, it's never again, because all those issues that led to those mistakes in the past, the capital market issues, there have been a series of regulations that now mean that we will not go that route again. For instance, there is a new regulation around giving loans to take position in the capital market. You margin loans and so on and so forth. If you must do it, then it must be eligible, and then it must be within certain regulations. And so over time, we have been able to craft policies that ensure that we don't travel that path again. And then, of course, there have been significant investments in capacity. Banks have invested in training to ensure that risk management, professional risk management practices are adopted, and underwriting skills were upgraded. And then, of course, we made them also to focus on the real sector instead of the superficial sector by creating bubbles in the capital market. But the implication of that is that for that to happen, then, of course, interest rates must come down, which was why we came up with the share services philosophy, that if all of them combine their resources together and we begin to think through how to reduce the cost of banking generally, that will translate into lower interest rates, which, of course, will be in the overall interest of the economy. And I think so far so good. Looking back with the benefit of hindsight, thank God we had 14th of August, 2009. Thank God we did what we did, and thank God the banks are up and running, and they're very strong. And today, Nigerians are proud of the banks that we have in Nigeria.
A very quick question. Do you think we have too big to fail banks in Nigeria?
Too big to fail is something that is fast disappearing from the lexicon of regulators all over the world. Because too big to fail carries with it what I call moral hazard. Because if I'm told that I'm too big to fail, then I can be as reckless as I can possibly be, because I know that if it happens that I'm about failing, then I'll be rescued. The philosophy of the regulators now is that we have significant banks that are very significant in their scale of operation, but we don't give them that freedom to operate as if should they fail, there will be no consequence. No. In the regulation, we have what we call living will and so on and so forth to address all those issues. And so there are consequences if a big bank fails. Incidentally, all of them today are very big, and we can't afford the failure of any bank of their size now.